Right now, SoFi stock is trading at exactly $15.71, down 42.8% since the start of the calendar year, as the broader market dials up the heat on high-growth financial platforms. But while the headline number looks like a brutal sell-off, looking at the raw price alone completely misses the institutional tug-of-war happening behind the scenes. The biggest surprise on Wall Street right now is that despite this massive stock slump, institutional whales are not dumping their shares. Instead, big money funds are actually quiet accumulators, taking advantage of retail panic to load up on equity at deep discounts. While everyday retail investors see the 40% drop and assume the company is in deep trouble, the large funds look at the fundamental metrics and see a totally different landscape. There is a dramatic mismatch between consumer perception and corporate execution, creating a massive pocket of volatility that is shaking out weaker hands while concentrated capital prepares for the long game. The baseline expectation among most retail traders is that this company is still just a glorified student lender struggling to survive in a high interest rate environment. The mainstream view paints it as a risky, unprofitable digital experiment that will get crushed if the Federal Reserve delays cutting interest rates. But the reality is that the underlying business has fundamentally transformed into a massive financial ecosystem. The company just delivered a record-breaking first quarter, posting over $1 billion in adjusted net revenue, which represents a massive 41% growth year over year. Net income scaled to $167 million, proving that profitability is no longer a temporary fluke but a permanent baseline for this business. Look at how the market reacted to those first quarter numbers. The company matched the consensus earnings per share projection at 12 cents and completely blew past revenue projections, yet the stock immediately dropped nearly 10% in pre-market trading and continued its downward slide. This happened because management left its full-year guidance unchanged, choosing a highly conservative posture that assumes zero interest rate cuts from the Federal Reserve for the rest of the year. This classic mismatch between short-term expectation and long-term reality is why the stock is experiencing such dramatic daily swings. Traders who were looking for an immediate breakout got frustrated and bailed, while long-term positions are looking at a business growing its membership by 35% year over year and realizing the underlying engine is running perfectly. When you track daily trading volume, it becomes obvious that the stock is highly liquid and frequently serves as a battleground for short sellers and growth bulls. The average trading volume regularly exceeds 60 million shares a day, placing it among the most heavily traded names in the financial sector. When macro pressures rise, whether it is sticky inflation data or unexpected shifts in treasury yields, the stock acts like a hypersensitive barometer for consumer credit sentiment. During the recent trading sessions, institutional activity showed concentrated blocks of buying near the $15 support level. Every time the price dips toward that low window, a floor emerges because institutional players realize that paying a premium for traditional legacy banks makes far less sense than buying a high-margin digital ecosystem trading at a compressed multiple. To really understand where this asset fits, you have to look at how it stacks up against legacy competitors and alternative options. If you open the Robinhood app or study standard platforms like interactive brokers, you will find a massive influx of users shifting away from traditional banking storefronts. Investors looking at traditional options like Fidelity Investments, Fidelity ETFs, Fidelity Mutual Funds, or keeping cash inside a Fidelity brokerage account are noticing a structural shift. The younger demographic does not want to manage their assets through a fragmented network of legacy firms. They want everything integrated. While traditional retail names like Apple stock or Tesla stock dominate consumer attention, the financial plumbing that handles consumer savings and loans is shifting toward aggressive digital apps. Consider how consumer habits are changing within the online investing landscape. Millions of people look for investment help through self-investing platforms, scanning various investing sites to figure out where to park their capital. Some choose automated options like Schwab Intelligent Portfolios or a standard individual brokerage account to buy individual securities like Nvidia stock. But the true value of a modern digital financial firm lies in its ability to cross-sell multiple services within a single ecosystem. This company is no longer just processing loans. Its financial services segment is booming, showing 41% net revenue growth in the latest quarterly report. When someone signs up for a basic checking account to capture a high yield, they frequently end up using the native trading platform to buy fractional shares, set up an automated portfolio, or manage their retirement accounts. Let's pause for a second to gauge the community sentiment here. Comment below how many shares of SoFi stock you currently hold in your portfolio and whether you are buying more or cutting your losses at these levels. It is highly valuable to see how real investors are navigating this volatility while the financial media keeps screaming about a banking crisis. When you break down the actual mechanics of what this business does, the long-term thesis becomes much clearer. Founded originally to address the specific pain point of high-interest student loan refinancing, the firm built its initial customer base among high-earning young professionals who were ignored by traditional financial institutions. The core business model is centered around a low-cost digital footprint, avoiding the massive real estate liabilities and overhead expenses that plague traditional regional banks. Instead of maintaining physical branches, the company reinvests those savings into higher deposit yields for consumers and better technology infrastructure. The genius of the strategy is the cross-buy phenomenon, which scaled to 43% in the recent quarter.
This means nearly half of all new financial products opened on the platform are being adopted by individuals who are already existing members. When a user moves from simple cash management to active stock trading, credit cards, or personal loans, the cost to acquire that customer drops to zero. That structural design is exactly why the company achieved an 18th consecutive quarter of meeting the strict Rule of 4 benchmark, maintaining a spectacular 31% EBITDA margin alongside its 41% revenue acceleration. However, looking at older reports and past performance reveals exactly why Wall Street remains hesitant and why the stock has been so heavily shorted over the past 2 years. The market has memory, and analysts remember the period following the pandemic when student loan moratoriums completely frozen the company's core business driver. The firm had to pivot aggressively to personal lending and home loans to survive, taking on massive execution risks during a period when interest rates were skyrocketing. While they successfully managed that transition, critics point to the recent performance of their third-party technology platform segment, which saw revenues fall 27%. This drop in the tech platform segment is a major talking point for bears, who argue that the company cannot successfully transition into a pure-play software provider for other global banks. This brings us back to the core tension between expectation and reality that defines the future outlook of this asset. The bear case expects consumer credit to deteriorate significantly under the weight of prolonged high interest rates, leading to massive loan defaults and forcing the company to write down its balance sheet assets. The market prices the stock with a massive risk premium because it fears that regional banking vulnerabilities will eventually catch up to digital lenders. The reality, however, is that the company's loan platform business operates with an incredibly smart asset-light model. They recently secured 3 new major platform partnerships representing roughly $3.6 billion in commitments. This structural setup allows the firm to originate massive loan volumes and pass them off to institutional buyers without keeping the credit risk on their own balance sheet. By acting as a high-margin toll booth for consumer loans rather than a traditional risk-heavy lender, they are generating immense cash flow while preserving capital. Furthermore, their student loan refinancing business is seeing a natural resurgence as borrowers realize that interest rates are going to remain higher for longer, forcing them to seek out digital optimization tools to lower their monthly obligations. Looking forward, the upcoming quarters present several clear catalysts and risks that will dictate whether the stock can break out toward its analyst target price of $21 or if it will continue to languish in the teens. The biggest catalyst will be the stabilization of the technology platform segment. If management can turn that software division around and prove that their infrastructure can power external financial apps globally, the market will stop valuing the stock like a cyclical bank and start valuing it like a high-multiple technology company. Conversely, the biggest risk is a severe macroeconomic downturn that triggers widespread unemployment among white-collar professionals, which could impair their high-quality personal loan portfolio regardless of how advanced their risk-scoring algorithms are. To bring everything into perspective, the investment narrative around this stock is a classic battle of duration. Short-term expectations are heavily weighed down by technical selling, macro interest rate anxieties, and a hyper-fixation on a conservative full-year outlook. The reality is a business that is consistently printing over $1 billion a quarter, expanding its product suite to 22 million total products, and executing a highly profitable consumer acquisition strategy that legacy banks simply cannot match. For individuals managing an individual brokerage account or looking at online investing options across the broader market, the current price compression represents either a major warning sign of a slowing consumer market or an incredibly attractive entry point into a structural winner that is quietly eating the traditional banking sector from the inside out. Understanding the structural divide between market sentiment and operational reality is the ultimate key to navigating this asset safely. Disclaimer. This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video. Comment your thoughts. Share with your friends. They'll subscribe for more updates.